our guest today, Todd Woodhead from Walton. Tell us about Walton. Tell us about Todd.
Yeah, well, real quick on myself, Todd Woodhead, EVP of Capital Markets. I wear a lot of different hats at Walton. I've been with the company 18 years, so seen a lot, done a lot. Currently help, as you know, Wally, to help raise our capital on the DST side of things, along with other products that we do. But Walton is a 46-year-old real estate investment firm that's privately held. It's second generation run. And it was our founder's vision, our original founder, to bring investors into the earliest stage of real estate, which is land, right? You can't do anything in real estate without land. And so 46 years ago, we started with 14 acres of land in Calgary, Alberta, Canada. That's where the family's from. Their last name is actually Doherty. And since that time, we now manage and control about 89,000, almost 90,000 acres of land throughout North America. In fact, most of that is in the United States. The company came into the U.S. around 2005, 2006. Again, I joined them in 2007. But ever since they came into the U.S., that's been the focus. In fact, we've moved our headquarters from Calgary to Scottsdale, which is where we're based, which is where I sit. And so really who we are, Wally, is we're the land provider to your biggest builders and developers in the United States. Those are what we call clients. Why are they a client? Because we sell them land, right? And so we're working with most of your top public home builders. I think in the top 20, we're working with about 13 of those groups. And then we're working with a smattering of development groups, whether that's horizontal developers, commercial developers, data center groups. We've sold land to Amazon, to Google, right? But most of what we're doing today is buying land that is going to be used for residential development. And for the simple fact that you build more homes than you build other types of real estate, right? So
how's the growth been since you guys started in 46 years? Has that been pretty linear, or has it been, have you had a style drift during that time, or has it been the same mission?
Yeah, no, it's the company in the 80s was really focused primarily on Canada, as I mentioned, raising money through Canadian investors. It really took off in the early to mid 90s, probably the mid 90s, when our current CEO, Bill Doherty, who's the youngest of the founder's 5 children, he was tasked to go out and start up offices in Hong Kong in 1992, and then Singapore in 94. And it's really just because the family had known some people over there, and the Asian investor, if you will, their goal is to get their money out of those jurisdictions because of tax, because of just political environment. So they were seeing they saw a big increase in capital raising and land acquisitions in the early 90s. It took off again for us when we came into the U.S. because the U.S. is a much bigger real estate market than Canada, right? So when we entered the U.S. in 05, 06, our global investors really grabbed onto that. And we took advantage of the downturn, frankly, right? In the 08 crash, we were in pure buy mode, as you can imagine, right? Getting deals at very good values. And so we saw a big spurt in the early 2000s. It tapered off a little bit for us in maybe the 2014-15 era, if you will. But now it's picking back up again from us on a global basis.
And is it all for development? Is it into minerals at all? Any of that?
No, we don't. We've bought land. We buy a lot of land in Texas, as an example. It's never a minerals play for us. We're typically buying land that's already been picked over. If there was any mineral rights or issues going on there from an energy perspective. So no, we're really mainly buying land that's going to be used for future development, whatever that development may be.
What are the size of the pieces of land that are typical for you guys?
It depends on the structure that we're doing. In our DST strategies, we're trying to find, I'd say, land that's 300 acres or less. What we're trying to do is find projects that a builder can ideally buy from us in a single transaction, maybe a two-phase takedown. But we want to keep those acreage small, because if you get too big of an asset in the land game, call it 500 to 600 acres, the biggest home builder in America, which is D.R. Horton, they're not going to buy that all at once. They're going to chop that up into a lot of phases. So as a 1031 client, as you can imagine, you come in with one exchange. And if, let's say, that property was 500 acres and Horton chopped it up into 6 phases, well, now you're getting 6 exits, which means you have 6 rolls, if that's your game plan, which is not a good fact, right? So we're looking for deals where it's 2 exits or less, ideally.
And so most of it is for the residential market at this point?
It is, especially for our DSTs. Yes. If we look at other deals, we're in data center discussions currently, and that's a whole different conversation that you and I can have later. But that's a long road, if you will. So yeah, most of our stuff is for residential development.
So are you guys in the urban infill kind of market, that part of it?
Yeah, I'd say we're in our DST structures. We're looking for assets that are kind of that infill asset, or I like to call that next in line asset.
Okay.
Right? That deal that maybe is right next to existing development, but it needs entitlement still before the builder can take it down. But it's next in line from that municipality perspective.
Okay. And do you all handle the entitlement as well? Do you do the whole land banking prep, get it ready, you wrap it up with a red ribbon?
Unfortunately, we don't. In the DST, in our DST, the way it works is our DST is a growth vehicle for the client, right? And so with the DST structure, us as the trustee, we can't add value. Right? You're just not allowed to do that. And what do entitlements do? They add value. So when we go market these assets to our builder clients, part of that negotiation is that they will complete the entitlements at their cost. And now you may ask, why would they want to do that? Well, they'll do that because they're going to sign a purchase agreement with us. So we can't sell the asset to anybody else. So now it's part of their inventory for the future. But more importantly, the public builders get rewarded for keeping land off balance sheet. And so with us, when they tie it up through a purchase agreement, it's not on their balance sheet yet. And so they'll complete those entitlements at their cost.
Yeah.
Meanwhile, it's not on their balance sheet. When the entitlements are finished, they can close and then put it on their balance sheet and start developing that first house.
So instead of land banking like they did back before 2008, now they're still land banking, but they're paying you with an option to lock up the property and not have it on the balance sheet. I got it.
Yep, they're putting down option payments or deposits. They're doing the entitlements, and then they close, and now it's theirs.
How much of what you're doing is in the DST model?
I'd say the DST is a newer product line for us. We really got into it in 2000. We started it in 2023. It is probably going to be, looking at 2026, our goal is to make it about an $80 million product, if you will, for our revenues. We're raising a lot more in what we call our builder land finance strategy. That is a strategy where builders bring us land that they've already locked up with a seller. They have it entitled, but they don't want it on their balance sheet, right? That's the number one goal of every public builder. If you talk to them, they do not want land on balance sheet. In fact, the Wall Street will penalize them if they're holding land that's not being developed, because in Wall Street's mind, you're a builder. You're not a landowner, right? And if you're holding land that's not being developed, that's a negative impact to your balance sheet. So in our builder land financing program, we'll probably do close to $800 million in deal flow this year. And again, this is where builders bring us their land and say, Walton, will you please buy this, put it on your balance sheet, and we'll pay you an interest rate to hold that asset for us. So that's a big part of our business right now.
Yeah. And then what are the ways that investors can participate? Obviously with a 1031 into a DST or cash. What else? What about funds, for example?
Yeah, with our DST, we're raising capital through 1031 folks, cash investors. We even get some qualified money from time to time.
Now, do you handle that directly, or do they have to go through a specialty custodian for that?
Typically, they're going to go through a CNB or an Inspira type of a custodian. Your bigger guys, although the current offering we have in Florida, Wally, that you guys maybe have seen, we decided to get audited financials on that. And with that, the bigger custodians will hold that deal, but I don't know that it's going to be something we do often. I mean, audited financials on a land deal, there's nothing to audit, right?
Right.
So we have been approved, I think, on that deal at Pershing and Goldman. But typically, no, you're going to want to use an Inspira or a community national bank for that qualified money.
Okay.
So our DSTs are single assets, right? Typically $4 to $6 million is our raise, and then our land financing program is a fund. We have currently on a fund today that's $250 million. That's in the broker dealer RA space right now.
Okay. How much of the business you do is through the RIA versus the broker dealer side?
On our DSTs, I'd say it's 90% through the broker dealer channel. Okay. And with our fund business, I'd say it's probably 60% on the RAs, 40% on the broker dealers.
Okay. On the RIA side, which custodians are you approved with?
Right now, on the fund side, our financing fund, we're about to get approved at Fidelity, from what I understand. Pershing, Schwab is probably not going to approve that. It's a debt structure. They don't allow private debt for whatever reason to be held at Schwab. So we just heard that we're most likely not going to be approved, but we're talking to them still to see if we can get them over the hump. But and then Inspira, CMB, your other lower tier groups.
On the DSTs, since it is land, how long do you end up generally holding it?
Yeah, with our DST, the way that we look at the strategy is we'll go out and we'll go buy the land all cash. This land is identified. Usually, again, we have a team of land acquisition folks on our side here at Walton. Or in many cases, it's our builder clients bringing us the land or showing us the land saying, hey, will you go buy that, right? We think that'll fit our needs. After we close on the land, we hold it for 12 months. And this is what I call the quiet period. And this is really just guidance from our securities lawyers who said, hey, you don't want to start trying to flip these assets too quickly. We don't want the IRS deeming you a dealer. So we sit on the land for 12 months, and then on day 366, we start to market the land to the builders. Again, in most cases, that land is unentitled. It's raw land, farmland, ranch land. And then when we get it under contract, the builder will do those entitlements, which typically takes, to be conservative, another 2 years. So we're usually looking at 3 years before we think we can get that first monetization event from a closing. But you're usually going to see a DST from us marketed at anywhere from 3 to 5 years.
All right. Very good. What is the debt structure normally on your deals?
0.
Okay.
No debt. Land and debt do not mix, and it's really simple. The biggest risk with land is time. And because, again, 3 to 5 years is a projection. If there's a housing slowdown, we may have to hang on a little bit longer, which is why we, utilize an all cash structure. We never want to be in a situation where debt is forcing us to sell the land at the wrong time. So we do everything in cash.
Very good. Is it most of the time where you have the buyer in mind before you get the land?
Absolutely. So I mentioned we can't market the land for 12 months after we buy the property. That is the case. But before we buy the property, we're having multiple conversations with builders and developers in the market. If we're picking the land, we're going to the market in terms of our builders and developers that we know. We're telling them that we're looking at this asset. Does it fit their needs for the future? What are their thoughts? And if we get a lot of, positive buy-in, if you will, that's step one towards us making an acquisition in a marketplace.
Okay. How about on the fund side? What's the debt structure like over there?
Yeah, we don't use debt either. We raise debt from investors, but there's no debt on the asset.
All right. That's what I was trying to understand. You mentioned that Schwab doesn't want to have debt in their private funds. So which debt are we talking about there then?
Yeah, so the problem with that financing fund is when the investors come in, they don't actually have equity in the asset, and that's one of Schwab's issues.
Okay.
Right. So they are an investor in the fund, and the fund has the equity, if you will, in the asset, but it's not directly tied to the client, and that's one of their biggest hurdles.
Very good. Well, tell me about do you have any deals that are getting ready to go full cycle?
Yeah, you got it. So again, starting in April of 23 is when we launched our DST. And let me back up before I get into our DST track record specifically, Wally. We've been around 46 years. We have had over 300 full cycle programs in our history. We've had a number of what I'll call partial exits, a number of like 50 to 60 partial exits on property. We've sold almost 46,000 acres over that time period. Not in a DST structure. These are different structures, over the years. So with our DST, again, we started this program in 2023. And we have not yet had a full cycle program. We are now on our 10th project in terms of raise. But the good news is three and almost now 4 of our previous deals are in contract. Our first ever deal in Georgia, we launched in April of 23. That's now going into contract. In fact, it just got signed yesterday by a group called, I believe it's Meritage Home Builders. They're public. It was a $3.2 million raise, and the offer on the table from Meritage is roughly, I think it's around $5.6 million. Good deal.
Nice deal.
Another deal we had in Charlotte, we launched in late 2023 or early 2024. It was a deal in Charlotte called Springhaven. We raised $2.4 million. That's in contract today for $4.3 million. Not a bad deal. We did a deal in Delaware. You might think, why Delaware? Delaware is blowing up right now with people fleeing Philadelphia, Washington, D.C., cost of living, just overall lifestyle. But Delaware, we bought an asset there in 2024, in January of 24, for $2 million, and we have a signed contract right now for 5.2. Pretty good deal.
Yeah.
And then our fourth deal that we're still working on, it's a deal we did up in Sacramento, paid $4 million for it. We had an initial offer for $7 million. We told the builders, go sharpen your pencil. We think it's worth closer to 8 or 9. And so we're hopeful that we can get that in contract, here in Q1 of next year. And then the rest of the deals that we've done, most of those are still in that 12-month quiet period where we can't market the asset. So those will start to pop here in terms of when we can start marketing those here going into next year. So far, so good in terms of activity. Still need to get one of them closed.
That's real good.
We anticipate the first deal to close is that Charlotte deal. Should be in Q4 of next year.
So is this, does it function kind of like a family office for the founder's family?
For the Doherty family that owns our company?
Yeah. I mean, is it a large portfolio underlying all of this as well, and this is working around the sides of it, or?
No, it's not really. I mean, all of our, call it 90,000 acres, are investor. I mean, they're investor owned. Does the ownership and family and Walton have side investments within those assets? Yeah, many of them. So
Got to be what, 200, 220, 230 properties?
Oh, I think I think you could say at least 200 to 250 properties that the company has, call it 5% ownership in, or more, right?
Okay.
So yeah, I guess in a way it's almost like a family office.
But the investors are investing alongside the Doherty family.
That's right. Yeah. Investors are taking down most of it. It's just our business, right? It's our business, and we need investors like yours and your clients to grow, right? And so they don't have, this is not the Walmart family. We're Walton, but we're not affiliated with Walmart. But we don't have those deep of pockets quite yet.
Do you see any kind of a REIT in the future, or 721, any of that? Everybody seems to be doing those now.
Yeah, no, we've talked about it. We're not, I'm not going to badmouth the 721s, but we're not fans of them ourselves. So no, I don't see that happening.
Good deal. Well, what's exciting coming up? What should we be looking forward to? And do you feel the market picking up at all?
Yeah, I mean, I certainly start to feel it picking up a little bit. I think 2026 is going to be a good year. You're going to see, for our business, specifically, it's geared towards housing. You got these rate cuts coming, right? That have already happened. There's expecting another one in December. And what we're always hanging our hat on, which is not going away, is the severe undersupply of housing in the United States. So, depending on the economists you talk to, we're anywhere from 2 million units in housing short to 8 million. I don't know who's right or wrong.
Yeah.
But let's just say it's 4 million. Well, that's a lot of units, and we're not going to make that up anytime soon. Yeah. We're simply not building enough homes. I mean, if you go back to 2020, which was one of the biggest boom years we've seen in 2021 with those 3% rates that we had, we were still doing less than 2 million units a year. So for us, we see a long longevity in land, because I don't care if you're building multifamily, single family, commercial, whatever it is, you need land to do it. And so we feel very good about our future, and I do believe that the 1031 market's going to pick up, especially as these rates come down, right?
So the developers that you work with, the builders you work with, are they responding to the starter home market, the demand there, which is, you can't find homes. I mean, what do they say? The average new first-time home buyer is now getting close to 40 years old.
Yeah. So the way they've been responding in the recent years, number one, they're building a smaller unit. So where maybe 10, 15 years ago, the average first-time house or starter home was, let's call it 22,000 square feet. Today, I don't have an actual number, Wally, but I would bet that number is probably closer to 1,500 square feet.
Really? Well, I know the lots are gotten a lot smaller too.
Yeah, the lots are getting smaller. The other thing the builders have been doing to combat the last 3 years of rates is they are offering huge incentives to their home buyers. And the most important incentive they're offering today is they are the mortgage company. If you buy a house from D.R. Horton, Lennar, Pulte, Toll Brothers, they're financing that house for you. In fact, here in Phoenix, D.R. Horton, who's our biggest client, they're offering in their communities a 30-year fixed rate of 4%. If you want a 7/1 ARM product mortgage from D.R. Horton today in Phoenix, they're offering 3.7%.
Wow.
So
yeah, I'll take the 4.
That is certainly driving sales for them. They don't want to keep doing it forever, but they're doing it today, right?
Yeah.
Right.
Yeah.
And it's helping them to move units, which is all they care about.
Now, how are they just carrying that as portfolio debt? Or are they bundling it and, just paying to turn it over?
They're just paying to turn it over. They know the average home buyer is going to live in that house on, I think their math and the smart guys on their team have figured out it's about 5 years on average. Right.
Okay.
Right? So, but yeah, it's moving a lot of product for them. I mean, they did 93,000 homes in 2024. Their fiscal year ended last month or October. I think they were at 86. It was a little bit down from 24, but still a lot of.
Yeah. Well, with the interest rates where they are, that's still excellent. So
Yeah.
Very good.
Yeah.
Anything else you'd like to cover?
No, I think we got it. No, it's just been a great working with you guys at Ridgegate, and looking forward to keep doing business with you guys.
Wonderful, man. Thanks for making the time.